All right, now we are going to discuss the workings of the statement of the financial position. And these are the really important five workings because whenever you are solving the long question, the constructive response question, or the objective test case questions, you need to know these workings in order to compute the figures. So working number one is actually the group structure, how much percentage the parent has acquired in the subsidiary. Usually this is given in the exam. If it is not given, then you need to calculate it. Now, how you can calculate it? So the simplest formula is taking the number of shares acquired divide by the total shares of subsidiary. Now, how you can get this information? Number of shares acquired by the parent. This is given in the additional information. Total shares of the subsidiary, you can take it from the statement of the financial position. But remember that thing, I've already told you that if in the equity it is written 5,000 balance, this is the balance. These are not the number of shares. And you need to see the worth of each share, the par value of each share. If each share worth $1, then these are actually total 5,000 shares or 5 million shares if you see the total. And if it is about like zero point 0.5 or 50 cents, then these are 10,000 ordinary shares. And if it is 0.25 per share, so remember this thing, like the same balance, 5,000, 5,000. It shows 5,000 shares because one share worth $1. So total number of shares will be 5,000. If each share worth 0.5, the total number of shares will be 10,000. If each share worth 0.25, the total number of the shares will be 20,000. So you need to take care of this point. You need to see the par value before you decide how many shares are there in the total. So number of shares acquired, let's assume 4,000 shares have been acquired by the parent in the subsidiary. The total number of shares of the subsidiary are 5,000 multiplied by 100. It gives you the 80%. So 4,000 divided by 5,000 into 100, it gives you 80%. So the parent has acquired 80% holding in the subsidiary. So in this way, you can compute how much percentage the parent has acquired within the subsidiary. Now, the percentage acquired is 80%. Let's assume the 20% would be the non-controlling interest. The 20% would be the non-controlling interest. Now, this 20% NCI is presented within the consolidated statement of financial position, and there will be working number 4 to calculate the NCI. And within the consolidated statement of profit or loss, you need to distribute the profit to this NCI. Share of NCI. That means within the consolidated statement of financial position, you need to have the working number 4, which computes you the figure. And in the consolidated statement of profit or loss, you need to distribute the profit of the subsidiary to the NCI. We'll be doing that later on when we are doing the consolidated statement of profit or loss. So the second working is the net assets of subsidiary. The second working is the net assets of subsidiary. Now the net assets of subsidiary at acquisition, net assets of subsidiary at reporting date. Now this is the date of acquisition. At acquisition means the date of acquisition. At reporting date means the date on which the consolidated financial statements are prepared. So these are the two things, the date of the acquisition. So you need to take the retained earning, the share capital, the share premium at acquisition, and the same thing at reporting date. The difference between these two will be the post-acquisition earnings of the subsidiary. It can be either the post-acquisition profit or the post-acquisition loss, which is going to be shared between the parent and the non-controlling interest according to their set percentages. So starting with the share capital, so taking the share capital of the subsidiary. So from where you're going to take this figure? From the statement of the financial position of the subsidiary. And remember this thing, that these two figures remain the same. Same figure at acquisition, same figure at reporting date. Then you take the share premium of the subsidiary, again taking from the statement of the financial position, and again these figures at acquisition and at reporting date remains the same. So it is going to be the same. And now we have the retained earnings. Now this is something really important to understand, that we have the statement of the financial position being given of the subsidiary. Now, if you go to the subsidiary statement of financial position, you will find the retained earning at reporting date. So the subsidiary statement of the financial position shows the retained earning at reporting date. But you need to calculate the retained earning at acquisition. And when the examiner asks you to calculate the retained earning at acquisition, so probably this is the case of the mid-year acquisition. Mid-year acquisition. So when you have the mid-year acquisition thing, for example, year starts on 1st January and year ends at 31st December, and you acquire the subsidiary midway through the year, anytime during the year. For example, it can be 1st April, it can be 1st March, it can be 1st June, whatever it is. Let's assume taking 1st April. Now you acquired the subsidiary on this date, which is 1st April. Now this is the mid-year acquisition. So you need to know the retained earning at acquisition. You need to know the retained earnings at reporting date. Now this retained earnings at reporting date, which is the last date of the year on which we are preparing the consolidated statement of financial position, this is given. Like you go to the subsidiary statement of financial position and you will find retained earning at reporting date. But this retained earning at acquisition is a challenge. Now you need to calculate this figure. How you can compute that? So there are two ways. First of all, whenever there is a mid-year acquisition case, examiner is going to give you the profit of the complete year. Examiner is going to give you the profit of the subsidiary of the whole year. The profit of the subsidiary, the whole year profit will be given in the exam. And the examiner is also going to tell you that this profit accrue evenly throughout the year. That means you can assume that this profit was evenly spread over 12 months. This profit accrue evenly throughout the year. So the profit which is given by examiner in the exam can be divided simply by the 12 in order to calculate the profit of 1 month. Now, why we are doing that? We have the retained earnings at reporting date being given within the consolidated statement of financial position. We have the profit for the complete year. Now, what I want to say is the retained earning at reporting date is simply calculated as retained earning at start of the year plus profit for the year. If you take the retained earning at start of the year and you add the complete profit in it, you will reach the retained earning at reporting. So take retained earning at start of the year, you add the profit for the complete year, and you will reach retained earning at reporting it, because we know retained earning is simply the accumulated profits. Whatever entity earns in terms of the profit, which is the profit for the year, is added to the retained earnings. So we take retained earning at start of the year and we add in it the profit for the year. Now, we already know the retained earning at reporting date. We already know the profit for the whole year. What we can do is we take the profit of these 9 months, multiply by 9 in this example, which I'm giving to you. So you calculate the profit of the 9 months and you deduct it from the reporting date. So if you deduct the 9 months profit from the retained earning at reporting date, you will reach the 1st April, which is the retained earning at acquisition. So the first method is take the retained earning at reporting date retained earning at reporting date, and then you deduct the profits to acquisition. Now you need to reverse it. You need to have the reverse calculation. You need to go 9 months back. You need to deduct the 9 months profit from it, because we know that this retained earning at reporting date includes the profit for the whole year. We need to go 9 months back in order to reach the first step. So take the retained earning at reporting date and deduct profits to acquisition, which is the 9 months thing. And then you will get the retained earning at acquisition. In case examiner gives you the profit at the start of the year, retained earning at the start of the year. Now, what you can do is simply add the profits of these 3 months, and then you will reach first step. So see what is given in the exam. If the examiner has given you the retained earning at the start of the year, and you need to go to the mid-year acquisition thing, add the profits in it. For example, 1st April, you need to add 3 months profit in it. You will reach the retained earning at acquisition. If it is about the retained earning at reporting date, then you need to have the reverse calculation. You need to deduct the month's profit from it in order to reach the retained earning at acquisition. So this is the important point, the most important point. So either it's given in the exam, which is the best case. In other cases, you need to calculate it. Now, when you're supposed to calculate it, that means it's a mid-year acquisition thing. Now we have the fair value adjustments. Now, what is fair value adjustment? This is the same thing which we have discussed within the property, plant, and equipment. When you are having an upward fair value adjustment, that means the fair value is more than the carrying value, then you need to add these figures at acquisition and reporting date. If the fair value is less than the carrying value, then you need to deduct these figures from acquisition and reporting date. We have done 2 examples of it, both upward and downward. So see in the exam whether the fair value is more than the carrying value or the less than the carrying value. If the fair value is more than the carrying value, you need to add those adjustments. If it is less than the carrying value, then you need to deduct it. The depreciation would go opposite. If there's upward fair value adjustment, then you need to deduct the depreciation from the reporting date. If it is downward fair value adjustment, you need to add back the depreciation expense. So it goes opposite of the fair value adjustment. Upward adjustment, deduct the depreciation from reporting date. Downward adjustment, add back the depreciation at reporting date. And then you have the unrealized profit thing, unrealized profit when the subsidiary sells to the parent. When the subsidiary sells to the parent, this is known as the unrealized profit, considering the goods are still in stock. Subsidiaries sell the goods to the parent on profit, and the goods are still in stock. So the profit on those goods are known as unrealized profit. So you need to deduct the unrealized profit when subsidiary is the seller from the working number 2 at reporting date. Then we have the other adjustments related to subsidiary. For example, you need to write off something like, for example, subsidiary is having any liability which does not exist anymore. For example, if they're having any asset which does not worth anything now, so you need to add or deduct those things from the acquisition and the reporting date. So other adjustment, again, belonging to the subsidiary. Other adjustments belonging to the subsidiary. Then this is the net assets at acquisition. This is the net assets at the reporting date. And the difference between these two, let's assume, name this thing as A, name this thing as B. So B minus A is equal to the post-acquisition profit or loss, which needs to be shared to the parent and the non-controlling interest. And now we have the working number 3, which is the goodwill. Now we have already discussed this thing, that goodwill either can be a positive thing or negative. Positive goodwill means you have paid more than the net assets, and that should be recorded as an intangible asset within the non-current asset. The negative goodwill is when you have paid less than the net assets, and that is the income which should be recorded within the consolidated statement of profit or loss. Now, what is the formula to calculate the goodwill? So first of all, you need to take the consideration. You need to take the consideration. Now, what is this consideration? Consideration is the amount paid by the parent to the subsidiary. It can be either in the form of the cash, it can be either in the form of the loan notes, like we did that in the associates, cash issuing the loan notes. It can be the share exchange, the total share of the subsidiary acquired, multiply by the fraction, multiply by the share price. Contingent consideration is when the parent is supposed to pay something to the subsidiary, but there are some conditions attached to it. And the standard says, irrespective of the condition being met, you are supposed to record the contingent consideration. The deferred consideration is when the parent agrees to pay a subsidiary some amount at some point in future. Now, both of these consideration belongs to the future. Contingent consideration and the deferred consideration, both of them belongs to the future. What we need to do, we need to calculate the present value of it. Now, the present value equals future value 1 plus r raised to power minus n. The future value is the future value, r is the rate of interest, n is the number of years. For example, the parent agrees to pay 1 lakh to the subsidiary in 2 years' time, and the rate of interest is 10%. Rate of interest is 10%, so 1 plus 0.1 raised to power minus 2. So 1 lakh, 1 plus 1, and then you will get the present value of it. For example, it's 0.826, so 82,000, let's assume 600. Let's assume this is 82,600. Now, this is the present value of the future payment. So contingent consideration or deferred consideration, you need to take the present value of it here. But remember that the liability is 1 lakh, not the 82,600. So systematically, we need to take this liability to its original value. That concept is known as the unwinding. So remember your F2 exam. The process of bringing the future value to the present value is known as the discounting. And when you take the present value to the future value, this process is known as compounding. So what we're going to do is initially we have brought the future value to the present value. Now systematically, we're going to bring this 82,600 to its original value. How we can do that? You take 82,600, multiply by the same percentage through which you have discounted it. You will get, for example, 8260. Now, what are you going to do with this thing? Debit profit or loss. This resembles the finance cost, and credit the liability because you need to increase your liability. So by the end of the year one, the liability is going to be 82,600 plus 8260. So by the year end, you will get this figure. In the next year, you're again going to multiply 10% with this figure. Like, let me just calculate it on my calculator. So it's about 82,600 plus 8260. So you get 90,860. In the next year, we're going to multiply the 10% with this figure. So rounded it off, you will get the 1 lakh, which is the liability in total. So this process is known as unwinding. So first of all, you calculate the present value of it, and then you unwind it. But for the goodwill calculation, we just need to have the present values over here. The unwinding is for the next step, which we'll be discussing shortly. So anything which is the cash, the loan notes, the share exchange, the contingent consideration, the deferred consideration, all of these are known as the consideration. Then we are going to add the non-controlling interest in it. Now, for the non-controlling interest, we have two methods. We have the fair value method, we have the proportionate of the net assets method. So you need to see in the exam what the examiner is asking you. In the fair value method, fair value is either given, which is mostly the case, or you need to calculate it. How we can calculate it? Take the subsidiary shares, multiply it by NCI percentage. When you take the subsidiary shares and you multiply it by NCI percentage, you get the NCI shares, the number of the shares the NCI is having in the subsidiary. And then you multiply it by the fair value of the non-controlling interest. the fair value of the NCI share, and then you will get this figure, which is the fair value thing. So remember this thing, fair value is either given or you need to calculate it. The next is the proportionate of the net assets method, which involves the net assets at acquisition. This is the A figure you need to take. You take A multiply by the NCI percentage, and then you get the NCI at acquisition. So consideration plus the non-controlling interest. Now, why we are adding it? We need to know the logic. So let's assume 80% is what we are having in the subsidiary. Now, this consideration represents the 80% thing. We need to deduct the 100% net assets of the subsidiary. So we cannot deduct mathematically 80 minus 100. We need to take it to the 100%, the consideration, and then we can deduct the net assets from it. So 20%, we add the fair value of the NCI. Now we get the 100% consideration, 80% ours, 20% theirs. And then we deduct the 100% net assets of subsidiary. You will get the goodwill on acquisition. Now, this goodwill is not only for the parent. This goodwill is a combined goodwill, which is of the parent and the non-controlling interest. Because realistically, what we are doing, we are consolidating 100% subsidiary. Do we take the percentage of the assets? Do we take the percentage of the liabilities while consolidating? No, we do not do that because we consolidate 100% of the subsidiary. So when we are consolidating 100% of the subsidiary and representing NCI in it, we need to calculate the goodwill of the both. And then you deduct the impairment. Luckily in F7 exam, the examiner will be giving you the impairment. Impairment is the reduction in the value of the goodwill, because goodwill is an intangible asset having indefinite life, so we cannot amortize it. We need to calculate the impairment, which is the fall in the value of the goodwill. So this figure is then recorded within the statement of the financial position. Now we have the working number 4, which is the non-controlling interest. So what we're going to do is NCI value at acquisition, which we have calculated in the working number 3. And then we'll be giving them the post-acquisition share. Remember this thing? This is the post-acquisition profit or loss which the subsidiary has earned. So this percentage will be given to the NCI. NCI share of the subsidiary's post-acquisition profit or loss. And similarly, the impairment, because I told you that impairment is of the both. So we need to share the impairment thing with the NCI as well, but only in the fair value method. This is the NCI figure that will go within the consolidated statement of financial position between the equity and the liabilities. The last working is the group retained earning, which is the simplest working. What you need to do, anything which belongs to the parent. This is actually the reserves of the parent, anything belonging to the parent. This is the reserves of the parent. Do not take anything of the subsidiary over here, except for the profit which the subsidiary has earned in the post-acquisition period, because obviously that belongs to the parent. But any income or gain belonging to parent will be coming within the working number 5. I'm talking about the realized gain, not the one which is related to the other comprehensive income, anything which is still the profit for the year. Any expense or loss belonging to parent will be recorded in the working number 5. So this is the simplest rule. This is the reserve of the parent. Any income or gain belonging to parent gonna be recorded over here. Any expense or the loss of the parent will be recorded over here. So parents retained earning, and we add the parents' share of the subsidiaries post-acquisition profit or losses. Then similarly, the impairment, which is now the parents' share. And this unwinding of discount, I've already told you that this unwinding is when you take the contingent or deferred consideration systematically to its original value. So what was the double entry for that? Debit profit or loss. That means the finance cost is debited, and credit liability, we increase the liability. Let me show you again. So what we did over here is we calculated the 100,000 present value, 82,600. And systematically, we take that 82,600 every year to its original amount, which is 100,000. So the process through which we are systematically increasing the liability is known as the unwinding. Now, this unwinding is actually an expense that is recorded within the statement of the profit or loss. So anything which is related to the consolidated statement of profit or loss should come over here. Then we have the acquisition cost to be expensed. Acquisition cost to be expensed. This is, the due diligence fee, like the parent has spent in order to analyze the acquisition decision. So any acquisition cost should be expensed out. Post-acquisition profit of the associate. We have already discussed it, that the 20 to 50% holding, if there's any profit from that, that belongs to the parent. Then we have other gains and losses belonging to the parent. And if the parent has sold goods to the subsidiary and profit, and that profit is still in the stock, then you need to deduct this unrealized profit from here. This is the group retained earnings, which is recorded in the consolidated statement of financial position. So these are the 5 workings. The working number 5 is the group retained earning. Working number 4 is the non-controlling interest. Working number 3 is the goodwill. Working number 2 is the net assets of the subsidiary. And working number 1 is the group structure. So group structure is in order to calculate the percentage. Net assets of the subsidiary is in order to calculate 2 things. So if in the exam, in the objective test question, the examiner is asking you to calculate the goodwill, then this net asset working is mandatory, because for goodwill, we need net assets at acquisition. Similarly, if the examiner is asking you to prepare working number 4 or working number 5, which is the NCI or group retained earnings, then we again need this working number 2, because we need to have the post-acquisition profit or losses. Working number 3 is related to the goodwill. Working number 4 is the non-controlling interest, and working number 5 is the group retained earnings.